Dr. Francois Stoffberg, thank you so much for your time. It's as always highly appreciated. I think we spoke briefly yesterday about where we're finding ourselves in terms of global markets and economic volatility. We've experienced this for a number of years, and I think on both our ends we are facing various discussions in terms of what is going on, and I guess it's a factor of whose crystal ball is charged to the maximum. I think at this moment. But I think if we could possibly just have and really, as I said to you, let's maybe just dissect what's happening here, and without going into too much detail, just on a high level, take a brief overview of what's going on. As the description says, the tail, the dog,
or the other way around.
So I guess with regards to whether South Africa wags the tail or wags the dog, I think that's obviously not the case. But I think let's maybe just take a bigger maybe a macro view of what's happening to the dog. I mean, what's happening in the developed world. And how does that obviously affect South Africa? And then maybe let's drill down into a bit more granular detail in terms of what's going on in South Africa. I guess there's a lot to say about elections and politics and the like. But maybe let's kick off. I mean, global inflation at an all-time high during 2022. I think that's obviously the price that we paid for what we've created in the stimulus flooded the market in 2020.
Yes.
But we're paying a hefty price. Whether we're going to see inflation coming down to 2%, I think we've got consensus that's not necessarily as realistic as we would have hoped. But markets are taking the strain. I mean, every morning when I open up my screen, it says markets pulled back due to higher than inflation, higher than expected inflation.
Yes.
So I think, and the same goes for my client feedback. Clients are we're running out of reasons for bad news, I think, and I think that's really where this starts. So yes, inflation plays a massive role. I think interest rates that was high, faster and higher and quicker than expected. Last year was obviously impacted the markets negatively. But where we're finding ourselves in at the moment, from a maybe just to start off in a Western perspective, in the US.
Yes, we like. Turning to the US first, not just because they're the largest economy, one of the wealthiest economies, but because they're kind of a proxy for the rest of the world, for the rest of the developed world at least. We all know that if the US sneezes, everybody catches a cough. So I think that's a good place to start the conversation, because they've kind of led this whole quantitative easing ramp up that we had from 2008-9 to now 2020 and even through COVID, and the fiscal stimulus, they led that as well. And then they kind of led this rampant increase in interest rates, like you correctly say as well. What is the fastest rate of rate increases that the US have ever heard? I think that most developed countries have ever heard of. So they're kind of leading the pack, the wolf pack, the developed market pack of countries. So yeah, I think you've correctly put it out. Inflation did come down, but it's still very high. And I think we're going to get accustomed to inflation between 3 or 4%. If we're lucky, some months you'll see it below 3. But I don't think the US is heading to a place where we'll see it at 2% in the long term. The 1.5, 1.8 that we saw like before 2008. I don't think we're there yet. Or we're not. That's not going to be the new normal, at least what people are expecting. So inflation is a little bit high. I think what investors are hopeful for is that the US somehow, for the first time, had the perfect game plan. Usually when you increase interest rates, 12 to 18 months later, you have a deep and hard recession. That's what history shows us since way back when they started monetary policy and all that. But now what they did is they kind of had COVID, and they had all this fiscal support as well. Literally, we call it helicopter money. They were flying helicopters and just giving people money. The average US household got something like between $4,000 and $8,000 extra just that year for doing nothing in 2020. And they got their salaries anyways, and then they got this money from government. So they had this fiscal support, and now they have the higher interest rates, but they have that fiscal support that's kind of still keeping them alive or kept them alive for a long term. So it's like, as they're weaning themselves off the one stimulus, the other one is still there, kind of keeping the consumer happy, keeping him alive through this, what we would have expected to be a correction already. So, and that's the thing about recessions, is recessions pass. So if you can somehow pass through it, you might be able to avoid it, or at least the very hard crash that we were all expecting to happen. That's kind of part of the long-term business cycle. So they might.
So this is the so-called soft landing.
This is the so-called soft landing, and that's the thing, is as long as this keeps going without major infractions, they might just pull it off. And what's interesting then is that you don't see a recession necessarily, but you just see flat markets. And then earnings catch up. That's the magic. That's what we're seeing. So we have earnings downgraded now in many of the companies. So you have earnings downgrade. So markets are already expecting something less. And if it's that less for 1 year and the earnings pick up, then you've kind of gone through it. Because remember, technically, the US was in a recession. There were 2 negative quarters. So the recession was there. You didn't necessarily see the -5%, but you didn't have to, because they were kind of keeping this whole ship moving along. So there is a slowdown. The market has already slowed down. The market and the economy, the US economy. And maybe later we can go into Main Street and Wall Street, because it's not the same that happens in the economy translates into markets. So we did see the slowdown in the economy. We have now seen the slowdown in the consumer, and many of the companies have also reported a slowdown in their earnings as well. So we are seeing that slowdown translate into their economy, and that can mean good things for a small open economy like South Africa's.
I read yesterday about the yield curve that's inverting once again. I mean, so this, I mean, all of the speculators, is that aligned to what you're explaining at the moment?
Absolutely, and I think the yield curve, we always say the bond market is the cleverest or the smartest market in the world, because everything is priced against bonds, or the US 10-year especially. So if all your risk rates, and that's literally everything, if a large company wants to buy something, they put it against the US 10-year. If we want to risk rate our equity, we put it against the US 10-year. If you want to risk rate the South African government bonds, you put it against the US 10-year. So all information cumulatively sums around or collects around the US 10-year. So the US 10-year bond market has the most information to digest. It's the cleverest market. So we actually, just after COVID, we already saw this inversion happen, and that was already forewarning. And then we had that technical recession. And then for a long time, it remained in that way, and kind of then started lifting out again, where the long end picked up, and now we have that inversion again. So that's the difficult job that the US Fed and then the US politicians in terms of fiscal policy is to try and see how do they continue to navigate through this Wipplank, the seesaw that they're on, to see if they can get it through a soft to medium type landing and not that hard crash that we're used to.
In terms of expected earnings going forward, I mean, let's obviously assume that inflation, sort of stabilizes to a certain extent. We see less rate hikes. We return to some sort of a normal financial environment. Yes. that we used to be accustomed to. Where's our next growth cycle coming from? I mean, is it sustainable for the US markets or developed markets rather, that to continue this enormous bull run that we've seen, yes, call it from 2009 and so forth? I mean, since global recession, the recover. Or are we possibly looking at alternatives? Are we, yes, possibly seeing a tilt towards the east, and maybe driven by China, India, etc.?
That's a good question. I think what we've been thinking, and I think what the major wealth banks, that Morgan Stanley's, JP Morgan's, Goldman Sachs, UBS, and some of the big names seem to agree with, is that there should be a shift back towards yield, towards growth, towards emerging markets, where that's kind of all collected in. What we've seen, however, is that, and this is an interesting thing, is that you would expect fundamentals to drive prices. fundamentals, cash flow, and all that to drive prices, price action. That is true, yes, in the very long term, I absolutely agree. But what we've seen now, and this shouldn't be the case, is where sentiment really does play a major role as well. Now, usually the two are completely separate things. What happens short-term sentiments, volatility and all that, but it doesn't drive long-term structural shifts. And that kind of changed, and we'll touch on later South Africa. It was most notably seen with the fire of Nene Gate, and then there was a structural shift. But similarly in the rest of the world, with all this quantitative easing, with all this fiscal support, with all this really playing on those borderlines of what's normal and what's miraculous, is that I think sentiment has kind of crept in. I think the world has grown so accustomed, investors have grown so accustomed to just having these high double-digit returns from the US. No bond, it was completely unnatural. There was nothing else to invest in except basically US equities, the five big tech firms. You couldn't invest in bonds, you couldn't invest in European bonds, you couldn't invest in European stocks, you couldn't invest in Japanese bonds or stocks, you couldn't invest in any other currency except the dollar. So everything was dollar. And everything was US equity. So now that's changed. So that change brings a lot of other shifts. Capital is looking for another place to flow into. People are waiting to see what will happen with the volatility so that they can make asset allocation decisions on a macro scale, large institution, pension funds, etc. Now, the rest of the world aren't really there yet. There's a lot of concern about Europe, a lot of concern about Japan, and a lot more concern even about emerging markets because it's wound up negativity. Like since 2008, nothing really good has been happening in favor of emerging markets. I mean, we read about Turkey and what Erdogan is doing with interest rates. You read about Brazil, Indonesia, Malaysia, Pakistan, Sri Lanka, even China, not really getting there. India really trying, but there's not enough structural reform. So nothing has been going. And we know all the stories about South Africa. Nothing has really been going for emerging markets. So investors have been blinded by very unnatural high double-digit equity returns in the US. Absolutely blinded. And unfortunately, biases like recency bias, a loss risk-averse bias, loss-averse bias, it's really blinded the investor and our clients to what is normal, natural, and what should be. So there you have to kind of take a step back and really consider what happens. How do business cycles work? Where do they originate from? What are these very long-term cycles that have always been there? And that's these money and credit debt cycles that range between 100 and 150 years. Then there's the reserve currency cycle that plays into that. That's usually about 100 and 150 years as well. Just by and by, the US has now been the dominant currency for about 100 years. That says something. That's why you heard all these talks about a BRICS currency, a Chinese yuan currency, a new reserve currency and all that. That's absolutely normal. It's been happening in the last 1,700 years. So there is definite in the long term a natural shift back towards emerging markets. Emerging markets, what we've seen on the equity side, at least in emerging markets, is that because of all this long-term negative sentiment, it's been weighed down. Now you can buy Chinese stocks, at 8.8 PE or 9 PE, that's a historic low. That's usually when the ramp up starts, the 8, 9, 10, 12 years ramp up starts. So that sentiment shift should go back to emerging markets. That seek for yield should go back. And then there should be a re-rating in emerging markets. Not something unnatural, just a simple re-rating as things normalize now.
Okay, so I guess that sort of ties into where we're finding ourselves in South Africa. So if that is the case, I mean, we've got a lot to deal with in South Africa. I mean, we've been experiencing very poor political landscape for a number of years, and I think our ruling party at the moment is faced with numerous challenges going into elections next year, as an example, and who knows what the outcome might be of that, and whether we actually see elections taking place for that matter, which is an interesting and a different discussion altogether.
Yes.
But I mean, so South Africa, we're dealing with energy crisis on a daily basis, etc. I mean, what does this shift or sentiment shift to emergings possibly mean for the South African market? Because obviously our clients are also invested in predominantly South African assets with regards to the
Exactly.
pension funds more specifically, etc., and non-discretionary capital. So how does that play out in your
Translate
view
to
going
them.
forward?
Mm.
Yeah.
Yeah. I'll just before I forgot to say that, so that I just kind of ease the concerns of everyone that has now invested globally and invested in globally hard over the last while. Remember, a shift from DM to EM, developed market to emerging market, doesn't say that your offshore money is now going to be worth less. No, we're still investing in the companies that are making money in the emerging markets. That's how you play it. You don't have to invest in Russia to play the Russian relatively strong economy, or the Turkish economy, or the Japanese, or the Chinese, or Vietnam's. You don't have to invest in them to really be part of that great Asian growth story. You can invest in the companies that they make their money there. And that's kind of how we see this playing out, is that there might just be, in terms of your global portfolio, a shift from DM heavy, DM revenue heavy, to a more EM revenue heavy portfolio, if that makes sense. And really, in this new normal that we see emerging, the companies that are going to be rewarded are companies with good and strong fundamentals. There's not excess quantitative easing and excess fiscal support to keep those companies alive anymore. You're going to need a company with a strong balance sheet, good cash flow, a good business plan that makes sense. Those are the companies that are going to be rewarded. So it doesn't mean Microsoft is not going to stop producing. That's what it gets down to, and Amazon and all these great companies. But there's a definite shift back to emerging markets. So that should re-rate at least many of the local equity markets, like in South Africa, China, because you can now buy Chinese stocks at the same price that you did 12, 15 years ago. I mean, if that isn't a bargain, what is? I mean, that's 15 years worth of growth that you're getting. So, so now most of our clients are a lot wealthier 15 years later. They're buying with a balance sheet like this, those companies at cents to the dollar, or yen, or yuan. So that's kind of the story that we're leaning into. So the emerging markets, as that sentiment returns, that the global search for yield, there has to be a re-rating, because many of the emerging markets have been doing a lot of things right over the last decade plus. A lot of things right. And just take what's been happening in Indonesia, Malaysia, even India, definitely, China as well, have been doing extraordinary things to kind of reform, bring better reform to drive this sentiment shift back in this re-rating. So now we're in South Africa. Now, unfortunately, because this cycle, this was kept unnaturally long after 2008, we haven't yet seen the 15, 20, 25% returns that we've gotten used to on the local equity market. Now people say it's because of politics and everything else. And yes, to a certain extent, definitely is. Long-term poor politics that leads to long-term poor policy can lead to a weaker economy, which we have, and that then can't translate into companies that are struggling. But remember, our companies make 70% of their revenue outside South Africa. So it can't just be a South African political story. And to really reiterate or drive this point home, that's why private equity, which we call smart money, because they take a very long-term view on their investment decisions, and then they kind of ride it out through the cycles. Private equity has been buying up listed companies in South Africa in the troves, in the hundreds. It's been like literally every year you hear Pepsi buying Pioneer, even where we work, Apex buying Efficient, and well, the BCI portion at least. So these are just two cases, and then there's ARB and all these other companies being bought out by smart money, because they say exactly what we're saying. They're investing into exactly what we're investing. They understand these long-term shifts in sentiment, these long-term shifts in capital allocation. So unfortunately for us as South African investors investing in our pension money, that's local equity heavy, we haven't been rewarded at all the last 7 to 10 years. And that's horrible. Usually you would have a 5-year cycle where you had -5, 5, 12, 25, -10, 5, 7, 9, 35. You would have this, and then this average of 12 to 14% from our JSE. Now people say that it's completely impossible because of politics. No, untrue. Can't be. It's impossible. The two don't match at all. Why we haven't seen this is, yes, to a certain extent, sentiment driven by negative politics, but definitely even more so about South Africa being a small open economy that's part of this larger economic shift of quantitative easing and fiscal support in the developed world. Everything was stacked against us. We could have performed better if we had very strong politics. Definitely, I absolutely agree. But Indonesia has strong politics. India has strong politics. China, we're not going to go into there, but it's fundamentally a strong economy. Why aren't their markets outperforming? Or India's market to a certain extent, yes, but not at all compared to what we've seen in the developed world. So in South Africa, unfortunately, our investors, our clients haven't been rewarded, but we are not just confident. I think if you understand what's playing out in the long term, there should be a re-rating. There should be capital flowing back, because at an 8-9 PE, it's just a joke. You're not going to see these high double-digit returns from the developed world anymore. You are going to have to look for yield, and that's what the smart money has been doing, and that's why we expect a re-rating in South Africa's market as well. Now, I'm not saying it's next year, and that's an unfortunate thing. I'm not saying it's in 2 or 3 years. I think there's a lot of now pent-up negative sentiment that kind of has to work out through this election cycle at least. So it's a 5-year period. But you can definitely start seeing that re-rating, let's say 2, 3, 4 years out. So I think just on that point is what we're trying to tell our clients is that if you're like younger than 55 years old and you still have 10 plus years to invest and contribute, you're buying equities at the lowest rate that they've been in 10, 15 years in the emerging markets. And then when that re-rating does happen, it's going to be massive on your balance sheet. It's going to be massive.
Yeah, I think so. So just to our clients, just to add on to what you've already explained, I think that's the mandate that we hold at Efficient Wealth. More specifically, I think, our mandate sort of rolls up all these moving parts, and our job is then to correlate your exposure to where we identify these growth opportunities, and more so to generate those upsides at the lowest possible risk. And I think that's where the challenge often lies. But I mean, that's why we appointed as your team of wealth managers at the moment. So thank you to you, Francois, for that backdrop and the context that you've provided. Just to add on in terms of the global positions, remember, clients with discretionary capital that sits offshore. The intention has always been, in terms of that component specifically, is to create a building block to offshore markets, not necessarily developed or US markets. It's exposure to offshore markets globally. So even where the sentiment tilts to other environments, we do have the ability to realign your portfolio towards those growth opportunities, as I said, at the lowest possible risk. So, Francois, thank you very much for your time and the backdrop that you've created. It's always a pleasure speaking to you, and your insight is highly valued. And to our clients, thank you very much for trusting us to manage your capital and the opportunity to deliver our services to you. Please do get in touch with us if there's anything in addition to what we've discussed today that you need clarity on, and we would be more than happy to assist in terms of more formal and more comprehensive feedback. Thank you very much for your time, Francois, and to the viewer.
Great. Bye-bye.